The beginning of the year had it all. Interest rates rose significantly in just a few days. In Switzerland, for instance, 10-year government bonds managed finally again to climb above 0%, so back into positive territory. However, this is not that positive actually, because the flip side of rising rates is falling bond prices. After all, in the short term, the situation is calming down at least. However, this doesn't change the fundamental challenge of government bonds. They don't offer a lot of return, but at the same time carry a lot of interest rate risks. The topic of inflation is driving markets. It's preoccupying monetary policy, namely the Federal Reserve in the United States, because wage inflation in the US is picking up, and this worries the Federal Reserve. So therefore, it increased the speed of tapering of bond purchases already in January. It very much looks like that bond purchases are going to be stopped in March completely. And it's also very likely that the first interest rate hike will also be in March, and more to follow later this year. While inflation worries, rising interest rates, this was negative for stock markets in the first days of trading this year. Especially high growth stocks came under selling pressure because they are most sensitive to interest rates. However, having said that, we remain positive on the outlook for stock markets in 2022. This has to do, on the one hand, with the Fed and its high credibility. The Fed managed market expectations very well so far. And on the other hand, we remain positive on the outlook for the global economy in 2022. Of course, in the short term, Omicron and supply chain issues are holding back the recovery, but we are confident that growth rates are going to pick up again later this year, and with that also providing tailwinds then for financial markets.